What's up, guys? It's me, EllioTrades. Today we're going to be talking about the number one superpower that you can use to make the most gains during a bear market. This is a very important topic as so many people are wondering, how do you make any money at all during a bear market? Now, I've been around this audience making content here for over 4 years in the crypto space, so I'd like to think I know a thing or two about how the audience does and doesn't behave. And so this piece of advice is uniquely tailored to the YouTube audience here in crypto. I think you guys will enjoy it, so go ahead, destroy that like button, because this particular skill set is what I'll be using to make 100x gains and beyond in the bear market here in crypto land. That's right. We're going to be going for the biggest of the big gains. And that's why it's so important that you do this one thing. So smash that like button. It needs your help. Make sure you subscribe, and let's get this video started. So today we're going to be discussing why it's so hard to stay on the sidelines during a bear market. And that's because bear market rallies are extremely vicious. They're extremely convincing, and they play into our deep-seated emotion and desire to see the number go green. That's why green numbers are just absolutely hypnotizing to the trader, to the investor, especially here in crypto land. They bring out that drug that we love most of all, that authentic, unadulterated, raw FOMO. That's right. That's what these bear market rallies do. Check it out. During the tech wreck of 2000 to 2002, the NASDAQ 100 declined negative 83%. During that time, there were 7 rallies of more than 20%. And this is in the NASDAQ, where the gains are about 1/10 at best compared to crypto. So consider this 200% rallies here in crypto land as a decent comparison. I don't know, maybe it's 1/5, whatever. The point is that you get way bigger rallies in crypto land. Now, as Simon says, you can get away with pretty much ignoring counter trend moves in a bull market, much harder in a bear market. Now, this much harder in a bear market is the point here, is that ignoring these counter trend rallies is extremely difficult. So let's talk about the main skill set we're going to be cultivating and discussing today. So here we have the Polygon chart. Now, Polygon has been one of the most price reactive coins in the entire market. Polygon, Solana, there's a few others out there that are high quality projects that have been extremely price reactive during this bear market rally. As you can see, Polygon went from about 34 cents, 33 cents, you could call it, all the way up here to about, just call it a buck, almost a 3x here throughout this whole move. Now, of course, there were some glorious bottom buyers and they rode this entire move up. But for the vast majority of mortals out there in the audience, and what I believe the YouTube audience is experiencing, is they watched this entire move up here from 30 to 60 cents and they were pretty much not believing the rally was on. And then once the dip came down and started to move back up, maybe you saw some of the YouTube audience get off the sidelines here. But what I've seen is that the YouTube audience tends to buy things once they break out to new highs. So if anyone were to buy this counter trend rally, in my opinion, you're looking at people buying probably the breakout again above 60 cents. Now let's look at the risk reward here, because yes, if you bought this ultimate bottom of 34 cents and all the way up to $1, you've pretty much 3x'd your money. That's a great trade. Of course, if you buy the bottom and sell the top, that is a fantastic trade. Now, could this go higher? For sure. But let's look at this, because it looks like the rally's kind of slowing down. As you guys know on this channel, I believe the lows are not in yet and that we will see more puking on these charts. So let's just go ahead and understand that if you were to buy where most YouTube audience members would buy, and I don't mean this negatively, I just mean after studying my own audience now for years, I've learned that slower long-term plays are more likely to net more success for this audience on the whole. And so I'm trying to curtail my audience to do the most good for that audience. And that means trying to cater towards plays that the vast majority of people can get right. Now, of course, if you buy at 34 cents and sell at $1, that's a great play. But it feels as though most people would only believe this rally during the second breakout here, as we're climbing up maybe at 50 cents or even up here at 70 cents as we break above this prior plateau. So to me, the most people on YouTube would end up buying this breakout here. So you end up with a move from about 70 cents up to about $1. That's not bubkas, that's not pocket change, but we're talking about a few percent here with the risk of losing and having it collapse back down to below 34 cents. So that would be a drop of over 70%, right? Those are the numbers. And to me, it's just not worth it, right? It's just not worth it. Ignoring this trend is very hard, but to me, it's one of the most important skill sets, even on one of the most important charts I've seen. I've seen so often that most of the people watching YouTube cannot respond this fast and are not nimble enough to buy the bottom and sell the top. They want to move with long-term obvious trends. And that's the goal of this channel, is to equip the audience with the ability to identify the next macro cycle where you'll have not just days, not just weeks, but years to get in and get out and eventually build some real wealth. Again, this is just my opinion, not financial advice, but hey, this is what I believe is doing the most good for the audience. And if you guys enjoy that, smash that like button, because we're trying to force feed you some vitamins right now, not painkillers. So she's a 10, but she thinks the Fed is going to pivot. Look, the Fed is going to pivot, but what we saw this week to me was actually a very bad sign because we had Jerome Powell come out and make some intentionally vague statement. Right after it, the markets went absolutely parabolic, but all he said was something vague about neutrality, which is not rooted in a hard number. That's not a clear destination. It's just a vague intention here. And then, of course, what did we see? As Mohammed here says, it's hard to reconcile the Minneapolis Fed President Kashkari saying we're a long way away with Chair Powell's neutral remark. Again, these are just political talking points because, like I said, we're coming into an election season and the Dems need something. So they're trying to pressure Powell to give them some relief without actually giving them some relief because inflation going parabolic is terrible for the Dems, just like the economy crashing is terrible for the Dems. They're between a rock and a hard place. So what are we getting? We're getting mismatched wording from Jerome Powell and then the rest of the Fed. What we have here is that Neil Kashkari said the central bank is committed to doing what is necessary to bring down demand in order to reach its 2% long-term inflation goal, a target that remains far off. We are committed to bringing down inflation and we are going to do what we need to do. We are a long way away from achieving an economy that is back to a 2% inflation, and that is what we need to get to. That's a reality, and we've known this, and we know that inflation is the highest it's been in 40 years, but somehow people are bullish on Jerome Powell saying we're reaching a neutral mark. Well, guess what? Neutral isn't the destination, maybe eventually. Again, we have Darius saying, you know, something went horribly wrong with the Federal Reserve comms when they have to walk Neil Kashkari out to push back on the market's dovish interpretation of the FOMC. Let the games begin. Again, this is more gamesmanship. You see this out of the last few meetings that there have been pumps right after the meeting, and then the rest of the Fed comes out and goes, hey, we think you misunderstood something. No, they didn't. They're playing both sides right now because they're hoping the economy doesn't completely crash while force feeding quantitative tightening to an economy that has just become addicted to McDonald's and fast food. Now they're getting some veggies and it's really, really gross. So what we need to understand is that each and every meeting, I'm looking for Jerome Powell to come out and say something that appears dovish, but in retrospect is just very ambiguous. That's exactly what happened this time. And if you look back, that's what's been happening. We have again, guess who's back? Feds, clowns will be back talking this week. Bullard on Tuesday, Mester on Thursday. Likely a lot more randomly will pop up on CNBC telling you how wonderful of a job they're doing. And essentially what this is saying is more of the same, which is you had Jerome Powell giving this sort of fake pump, which just gave the market a little bit more relief. Again, Bitcoin didn't even touch the bear market rally target of 25K, which we said Crown had called weeks ago, and same with Wifey Alpha. This is just the benchmark target. If it starts going past 25K, that's when I'll start looking for a major sign of a reversal. Again, calling this market to the T is not something I'm going to pride myself on. That's not my skill set, but I do have the feeling we're in a bear market rally very, very strongly. I do feel like it's going to move way too fast for most people to actually get the benefits out of. And that's why we're going to wrap this up at the end and tell you the skill set that I believe you need to know. But first, let's justify my viewpoint with a little more surrounding data. The bear market bounced in July from extremely negative sentiment levels, which matter, sentiment matters, and oversold conditions. Yes, things were way oversold and things were way overly negative, but be careful. It's not like earnings outlook has improved. Quite the contrary. The earnings outlook has not improved. For some more shocking data, we have Liz Ann Saunders here, who is the chief investment strategist at Charles Schwab. Savings rate continues to evaporate, now at the lowest levels since August 2009. Look at how shocking this chart is. From a savings rate that was one of the highest on record here over the last year and a half, we have a complete free fall here to what looks like could be challenging record lows. Also, this is something I've been predicting, which is at a certain level, this crazy bubblish housing market is needing to take a beat. It needs to come back down to earth, if not a little bit below the norm, maybe even having what we know as a crash. Here we have the first signs of cracks in the armor here, with a 2-month change in median price of new single-family homes has cratered to negative 11.9%, almost a 12% drop in 2 weeks, which is the worst in history, even beyond the housing crash during the great financial crisis. This chart shows the median house price and how it's changed over the last 2 weeks by percentages. As you can see, this line tip down here is lower than even in the 1970s, even during the great financial crisis of 12%. So as you can see, these historic drops, you can think of like huge down moves on the chart, which can trigger yet another series of down moves. As we've seen, as you break trends on the charts, and by the way, housing market is as high as it's ever been. It doesn't even make sense to buy homes in so many different regions of the United States. It just is illogical. Now, this is being fueled, of course, by almost no supply of new homes coming out because of supply chain issues, but also you have a much healthier lending market. So we're not going to have the same type of crash we had in 2008, but the slowdown in demand is real because the whole macro economy works together. So while it's not the same causes as 2008, in my opinion, we could be looking at a major pullback in housing. So this is the first sign of that. And when that happens, you better believe it'll affect demand for tons of other different assets, including risk assets. But things are not just myopic and simple. And this is where we get to some of the most complex economic conditions we've ever seen. So as we can see with Lynn Alden, she's saying the US broad money supply has been flat year to date. It's the longest stretch of non-growth in the broad money supply since mid-2009 and before that mid-2003. As you can see, this flatlining here is completely irregular when you look at a chart that has grown almost continuously for the last several years. So this flatlining again means that less new money is coming into the economy, which means that, of course, we should see a slowing of inflation to a degree and an increase of value of the dollar versus goods and services. So again, this would be bullish if this takes inflation down a bit and we can return to normal economic conditions, but we just haven't seen the evidence of that yet. So just know, not everything is just pure and simple headed in one direction, and that's why calling short-term moves on this market is completely crazy, and why we get back to the number one skill set that is truly a superpower in the bear market. As this humble DeFi farmer says, I will repeat once more, bear market rallies are intended to make you think we are no longer in a bear market. Prices will go up, fundamentals will look seemingly good, and sentiment gets better. This humble DeFi farmer thinks that they're closer to the end of a rally than the beginning, and I happen to agree. This is what happens. That FOMO comes along, all of a sudden prices start increasing, time passes, we haven't seen a major rug, a major level down in price. All of a sudden the news starts shifting, you see the bull calls left, right, and center, people are making fun of the bears, people on the sidelines, but that's precisely it, is that sentiment change and all those different factors actually take away bull momentum in the long term. And the reality is that effectively it makes it so hard to sit on your hands and be on the sidelines, which is precisely the most important skill that most people, again, not everyone is a sophisticated trader. If you want to be a sophisticated trader, go watch Eric Crown on YouTube. He's the most sophisticated trader. Eric Crown, YouTube, he is the absolute GOAT. I've seen him crush these markets throughout 2018. And again, he's been calling these moves with precision. So if you want super high level trading content, go there. But the reality is most people should be doing this one thing. And that one thing is very simple. You should be sitting on your hands and waiting. This is one of the most complex, confusing, and directionless markets I've ever seen in my life. We have unprecedented economic conditions. We have macro contagion. We had complete cascading liquidations in crypto. We have oversold conditions, but we have absolutely horrific support for risk assets. We have a slowdown in the M2 money supply, but all the while we have weakness across the board in other parts of the economy, which will eventually create contagion. This is way too hard to be calling. So either you do something very simple like DCAing and doing it over the course of years, which is never a bad strategy, or you sit on your hands for the most part and wait for things to look a little different. Because right now, understanding which way the wind is going to blow in the next few weeks is too crazy, and no one can do it with precision. Everyone has been made to look like a fool in one way or the other. Now, calling aggressively one move over the course of weeks, in my opinion, is not good for the YouTube audience. The YouTube audience moves a little slower and in general is more susceptible to the drugs of FOMO and FUD. Therefore, in my opinion, most people watching this video should be best suited to sit on their hands and wait. The reality is that no one is going to put all their money in at the exact bottom or pull it all out at the exact top. So the goal is just to understand when the macro trend has eventually shifted and start allocating into that increasing trend market. And I do believe that you'll have tons of time there at the bottom to eventually build up your stacks and have an amazing portfolio growth through the next macro cycle, which will take years. But in my opinion, there has been zero evidence that the Fed is going to blink and change their policy. They're determined to drain liquidity from the market. And while that's happening, that's like trying to surf on a beach where the water is just being drained out to sea. Eventually, you're just going to crash into the sand. It's not a pretty situation. And in my opinion, it's far too advanced for most people to be trying to do. So unless you're one of those top 1% traders and have some significant experience here, I believe the superpower for 2022 is to do a lot of nothing. And as you can see, when prices are going 3x in just a couple of weeks, like with Polygon, it's extremely seductive. You're like, oh my God, I'm missing out on all the gains. But the reality is that most people, by the time you realize that the trend is on, are too late to really catch the good part of it. And you're exposing yourself to far more risk by chasing. Again, I could be wrong. I'm just a guy on the internet. But my gut is saying that we have lower prices ahead, that we have not achieved the Fed's mission, and that until we start to see them start to be satisfied with inflation prints and other macroeconomic resets, we can start allocating with far more confidence to risk assets in general. Again, I've been through this in 2018. I've got the scars to prove it. And the one thing I wished I had done throughout the entire year was just be patient. And it's so hard to do when numbers are going up and they're green. But remember, there's absolutely no reason for this besides it's too negative, it's oversold. Those are good reasons, but those aren't great reasons. As Darius Dale reminded us, you shouldn't just buy because there's blood on the streets. You should buy when there's a catalyst to clean it up. And I believe that catalyst is coming, but the fact that the market has been so bullish actually makes me think the catalyst is a little further away than we had hoped. Short-term bullish is long-term bearish. We actually want more bad news up front, more on that in upcoming episodes. The point is, I'm gonna be giving you my entire playbook and actually creating a portfolio that I plan to grow by 100x over the coming years and making it all public for you. I have a video coming out that I'm gonna be going over my exact strategy. And again, my goal is to develop a long-term wealth building strategy here in crypto land, one that I believe is something that most people, if not all people, could actually get their hands around. And that's the content I'm going to be giving to you. So if you guys are excited for that, destroy that like button. And of course, remember to subscribe so you can follow each step of the journey. As always, if you enjoyed this video and you want to sign up with the absolute best exchange in the business, you should try FTX. This video is not sponsored by FTX. I love their product and I always use it for myself. I highly encourage you to check it out with the link below. They have an amazing feature where you can dollar cost average over time, the lowest fees in the industry. Anyway, if you're not signed up for FTX already, you should check it out with my link below. As always, my name's EllioTrades. I thank you so much for watching and I'll see you very soon on the next episode.